Welcome back to Down the Middle. I'm really excited. We recently spoke with Richard Werner, who is world's preeminent expert on everything Bank of Japan, 1989, everything that went wrong following that spectacular episode that culminated in more than 3 decades of lost growth in Japan. Today we have with us somebody who can really distill what happened there, but also explain the implications and why central banking and central bankers have taken on the same approaches throughout the past few decades, what that implies and what it means for the United States of America. Are we going to be Japanified? So I'm delighted to introduce to you George Congalvis. Thank you for being with me today.
Good to be here. First time in the city in a while, so a good time to. It's been over a year.
That's right. This is both of our first times back in New York City. So this is the post-COVID road mission, and it's before we get to the road warrior, who you are and everything you've seen. Why don't you tell us a little bit about what got you so interested in plumbing? I'm not talking about the plumber who charges us too much money, not that, but the financial system, liquidity, how it works, how it behaves.
Well, I mean, I might actually go back to the plumber analogies anyway, because there is obviously a lot of connections to how liquid moves through a system. Mm-hmm. And I'm going to just throw a personal thing, which I rarely do. When I was growing up, my parents would always send me to Portugal for the summer break, so I would always be there. It's a mountain region, an agrarian type society still, mm-hmm. and they had all these like levees and little like water dams and things like that.
Sure.
And I would always just play with them. I always kind of figure out how fast things would move. Obviously, when you're a kid, you're trying to figure out how fast boats are going to go down these little channels. All joking aside.
Amsterdam reminds me of Amsterdam. Anyways.
Yeah, absolutely. So, but in general, I've always been intrigued by systems and how one action has another reaction, and figuring out how things work through these elaborate structures. And the banking system, especially the plumbing, is so complex, especially in the U.S., more so than it is in Europe. And Europe has its own complexities, but in the U.S. with parallel systems, with an actual commercial banking system, mm-hmm. a money market system, we have the GSEs and all the kind of government-sponsored type lending facilities. A lot of off-balance sheet in general.
Yeah, I don't think the rest of the world realizes, or I don't think Americans realize, that Fannie and Freddie don't really exist in other countries, and that they're a larger debt market than the Treasury market.
Yeah, so it's amazing when you start. So I started off my career on the Merrill Lynch money markets desk, mm-hmm. and that's where I really kind of got involved in understanding how repo works and how to trade short-term obligations. And it was the late 90s at a point where financial innovation was already starting to kick up in a very fast way. A lot of SIVs, asset-backed commercial paper programs, all this stuff was looking for ways to source cash by mm-hmm. posting some sort of collateral. I mean that
this is Enron times.
Yeah, we were it was really just like the Wild West of liquidity, and it worked for a while. I mean, it worked even we got through the dot-com crisis, and it was not tied back to excess leverage in the bond market or money markets. I mean, there was parts of that. We had a brief glimpse of that, of course, with long-term capital,
right, and
the excess leverage that was being employed there to squeeze every little basis point to put on these arbitrage trades. But that was really the start of my career, and I got really interested in it, and I read every single book possible out there on money markets, and over the course of my career have built my strategy framework around understanding the flows, understanding the plumbing, mm-hmm. Understanding where there's going to be potential bottlenecks and pressures, and then around each of those nodes, look for what's priced in and what's not priced in. Mm-hmm. I was also fortunate enough to be educated by some of the smartest strategists and traders on the street. I mean, having worked both at Merrill, Morgan Stanley, Bank of America, yep. These were all great premier names with amazing people that were actually in the front lines doing these sort of activities. So I really got a front row seat of seeing how the whole process comes together. It works, and everything was obviously working fine until we started to as we all know, go into the subprime / housing period of the early 2000s. At that point, that's when the wheels almost came off. As we know, it was leverage upon leverage, but a lot of it was still it was designed to satisfy a need, which was a lack of short-term collateral. There was not enough short-term paper in the system of high-quality assets. So they were making up AAAs as they go.
Credit rating agencies were going stamp of approval, AAA. And investors believed it. And around that time, I had just met you, and you were making a big change in your career. You were moving from one big firm to another in a very turbulent time in the markets.
Oh, sure. I mean, and look, I mean, and really what was happening then was just questioning around what is LIBOR funding, it's access to dollar liquidity.
Right.
Before 2006, 2007, before my change to the last shop that I was at, it was a period of realizing these excesses have built and that there was just not enough actual underlying to support it. And the Fed, of course, eventually figured that out and flooded the system with, even to this day on a percentage basis, what they grew the balance sheet back then, we've never done so far, right?
Right, because they were starting from a base of below $1 billion. People forget that it was 800 and some odd, the Fed's balance sheet was 800 and some odd billion prior to the launch of
all the QEs.
Quantitative easing.
Yeah, and even before that, they had all those liquidity programs, which we know, we discussed. They reintroduced during COVID because they had them, on the shelf somewhere. But
so background here for just a second. George was my chief advisor when I was advising Richard Fisher on the markets. I didn't understand the plumbing, but I needed to be able to explain it to President Fisher. George was my go-to man. So throughout all the crisis years when I was inside the Fed. So FY background. Anyways, continue.
No, thank you. Yeah, and look, I obviously enjoyed our conversations and working with you now as well. It's an area people don't really spend too much time on, but now they do. But even then, they still don't get it at this point. And even there's Zoltan
Pozar, who I worked with at the Fed at the time. I mean, I had to make 2 separate trips to New York. That's how, we spent 2 solid days together in his office, and the size of the map of the financial system took up his entire wall. And he was the only person inside the entire Federal Reserve who understood the plumbing of the financial system. And it still took me 2 trips to understand what he was talking about with this quote unquote tri-party repo system at the very nucleus of everything that was unfolding after Lehman went down.
That's right. And I've never seen that map, and you've kind of illustrated it for me. And I think he has some paper out there that I found, that's a Fed paper that he's published a lot of work on that. When he's at the Fed, and of course now he's on the private side. But it's complex stuff, and then it's hard to make it relevant to what it means to the here and now in the markets.
Right.
Until something like breaks. And so it's all working all fine and good. If you go back and you look at the shadow banking system, and I just did some quick numbers looking at these non-bank entities, like the GSEs, like repo desks, like the credit component of private equity. If you look at all of the ways that you can source cash around the U.S. financial system that's not sitting on a bank depository's institution's balance sheet.
So I think the biggest banks, Bank of America, JP Morgan, the cash they actually have on their balance sheets outside of that universe.
Outside of that universe, but even just their overall deposit base, not their cash, but customers' cash, money market funds, all that stuff. Right now, from what I calculate, they're almost like an even split of like 20 trillion off balance sheet and 20 trillion on balance sheet for a total of about 40 odd trillion. And I was doing this last week because the Z1 data came out, and I was just playing around trying to figure out. And I was like, wait. So let me run those numbers backwards. What did it look like in 2007? The shadow banking system was bigger than the real banking system.
I remember Timothy Geithner made a speech, and he said that it was $17 trillion at the time.
Exactly.
And people were like, wait, that's bigger than the conventional banking system.
Yeah, exactly. So if you add those 2 together, and then I feel like what we have to do going forward, I think people are starting to get on with this idea, normalize everything by excess reserves. If you do at the peak of...
So wait, explain what an excess reserve is.
Or just reserves in general, right? So the Fed, through its quantitative programs, has created electronic cash or reserves that get deposited at the Fed T accounts of individual banks.
Because they're buying $120 billion of securities every month.
That's right.
Post-COVID.
Sure. And before that, they bought X 3 trillion before that. So,
Right.
so in total, since the financial crisis, close to 6.5 trillion or something. So all of that QE and what they're buying has to get credited somewhere in the system, and it gets credited as a reserve. Pre-crisis, we did not have a large reserve system because the banks had a different regulatory regime in general, but also there was just really that oversight was not there. Plus, there's a view that the banks were self-regulating themselves in a way where, oh yeah, those are high-quality liquid assets. They can sell them on a dime if they have to raise cash.
Right.
And of course,
and then the crisis came and we went, whoa, where'd the liquidity go?
If I'm right, and maybe I'm off by a couple of multiples, but it doesn't really matter. It was 777 times the level of reserves in December 2007. 777 times larger when you combine shadow banking and the overall public banks.
So paper thin cushion.
Very paper thin. Now, actually, we are at 14 because the Fed has pumped in so much base money. So the monetary base, this is the part that I've been struggling. You and I have been talking about this for the last year because now everyone's worried about all this printing of money and everything. And I think, as you mentioned, Richard Werner in your intro, also has been a spearhead on this concept. It's not the central banks that really create the money that goes out into the real economy. It's the commercial banking system or the shadow banking system, either or, right? But it's the private sector that pumps in excess dollars when people take out a loan and they get deposits.
And that's why purists get so mad when they say that the Fed is printing money.
Yes.
The Fed is not printing money technically. If the Fed wanted to print money, then the Fed's liabilities would be legal tender and there would be no auction process.
That's right. It would just go out.
But the Federal Reserve Act of 1913 dictates that the Federal Reserve can only buy treasuries in the secondary market, and that brings in an outside presence.
Which is the commercial banking system. So they still operate. So they have to. Their monetary policy is still somewhat. Some would say the non-purists or the ones that are or the MMTers were oh, that's a constraint. We shouldn't have to go through the banking channel. We should just pump it right into the economy, and then we'll see what inflation does at that point.
Don't jump ahead, but yes, we would.
Yeah, no. Yep. So, but right now we're about 14. I went back and I took that number all the way back because the Z1 data goes back to 1945, because that's one of the good post-war data that we have. And it was also about 14, 19. So basically, the Fed has de-risked the off-balance sheet system and also made the commercial banks very cash rich. And you can argue that means that they're strong, I guess.
But you're speaking with 770 times versus 14 times, but specific to the commercial, to the conventional banking system?
Both of them.
Including shadow banking system. Okay.
Because they're both now roughly about 21, 22. Because the shadow banking stalled after the financial crisis. It actually dipped.
Yep.
But it's been growing back up again in the last 5 years. As you know, there's been a lot of just, CLO activity. There's been a lot of just overall.
Think of private equity and the mountains of dry powder and the billions of dollars that they've raised.
Yeah. So that part has been on the upturn. But the commercial banking system, I actually am not too terribly concerned about where they stand. I mean, they're super capitalized. I mean, they own assets that can go down in value like everybody else.
Right. But I mean, if you think about, here we are in Manhattan, full of one high rise after another. And yet the largest bank's exposure to commercial real estate, which was very problematic in 2007, 2008, that's not the same situation today.
Yeah, no, agreed. It's actually
but smaller banks.
But smaller banks, however, yes, they took up the slack of that, and that's a whole other. Yeah, there's obviously differentiation within the banking system. I don't want to throw out a blanket statement, but I'm not that concerned there. But so if the Fed de-risked the system, and now I think we just heard some news that they're not extending the relief on the SLR,
supplemental leverage ratio.
Yes, thank you. Perhaps. They're really, they're asked to hey, banks, start to lend.
Right.
Because the only way they're going to be able to grow into this excess cash that's in there, they have to start lending out.
Right.
And then hopefully that creates a money multiplier.
Right. So there's another thing to stop, and this is an educational moment, if you will. The amount of money in the system, M2 as we call it, is extraordinary. But maybe you could parse out the difference between a lot of money being in existence and whether it's moving or not.
No, and it's not. So, and then the inflation is. I've been a diehard deflationist, and it's worked well for me because
about 40 years now.
Yeah, the last 40 years has been the right move to be the bond market's going to tend to be right over time because more debt, more leverage, harder to finance it, disinflationary pressures, globalization.
And people don't understand that the simple creation of money is kind of by definition deflationary because you have to service it all.
That's right.
So, and unless it's put into unless you pick up velocity, you're not going to get inflation.
Less velocity, or you do debt jubilee and you actually extinguish debts, and that's not going to happen anytime soon in the U.S. We'll have bigger problems in our hands.
Not according to China.
Yeah, and so I think this idea that we're going to grow our way out of this and we're going to somehow see like all this fiscal spending amount to a robust, sustainable recovery. I think you and I probably agree that it's more like a flash in the pan. It's going to increase activity, but then we'll see on the other side, right? But let's say that we're wrong, and they just somehow say, like, they're shaking the magic money tree, and they're going to keep doing all this fiscal spending. Who's going to buy all this stuff?
Right.
Who's going to buy all the treasuries?
And we're going to get there. We're going to get there too.
Yeah.
But first, I want to go back in time a little bit. So you are a study of, because when you were at Nomura, you went to how many countries and how many? Once a year, you were everywhere.
So given that I formerly worked at a Japanese bank, and there were obviously a huge presence in Asia. I spent a lot of time in Asia, probably 3 to 4 times a year, and I lost count. I had like 3 passports. I went through like 3 passports in the course of almost a decade because I kept expanding them, and then they stopped allowing you to expand.
Yeah, try
them.
being in Dallas, trying to get you to be in New York. When I'm like, okay, we're in the middle of a crisis here. Would you quit hopping around the globe already and get in New York?
Well, anyone that knows me and knows my style and work ethic, I'm on like almost 24/7. And so if you want to find me, you can probably find me somewhere virtually. But I don't know. I think probably 90 countries. It's an insane amount, and I'm very grateful for all the opportunities that I had, and I've met some amazing investors, and that further educated me because I'm not a PhD economist. I mean, I think most of my investors and clients that liked me over time like me because I'm the real deal, and I just call it as I see it.
Sure.
I've iterated over the years my process and approach. I got trained by some of the best people on the street. And I've been just kind of improving my process.
Right.
But I don't get stuck in. I'm much more tactical instead of these super long-term views that who knows if they're ever right anyway. So I'm much more like, again, plumbing, understanding the system, having honest conversations with clients. But this experience of being exposed to so many different kind of investors really enriched me to a point of understanding that it's not just the American way or outlook on the economy. We have to think about, especially Japan, and having worked at a Japanese institution. Well,
you got to see how hard a central bank could try to raise inflation and fail. I mean, as we were both getting ready for this, overnight, the Bank of Japan finally raised a small white flag and said, okay, maybe this isn't really working the way we want for it to work. I mean, this was the first concession in,
God knows so long.
I don't know.
Yeah, I agree.
But back to Japan for a minute. A few weeks ago, you sent me a chart that blew my mind. Because we look at the SPACs and the IPOs and the fever and the teenagers who are on Reddit and Robinhood and Bitcoin. And I'm like, this is just an amazing bubble. And you're like, you want to see a bubble? So you sent me a chart. And at the peak of the dot-com bubble in 1999, 2000, the price to earnings ratio was somewhere around 45.
In the US,
At the peak of the Nikkei bubble, it was 99.
Yeah, depending on which calculations, it was up there. It was like 70, 90.
A multiple of 2 of whatever it was
easily.
When it was crazy here. So, I mean, that leads me to believe that bubbles can get bigger.
They can. However, I just don't think the market structure in the U.S. is the same way that you can have such a concentration like what took place in Japan. Literally, Japan is an island. But even in the way their financial markets are designed, and the fact that it was much more inclusive and there was less kind of...
Who owns Japanese sovereign bonds?
Well, majority of the Japanese.
Right. And how does that differ from the United States?
Yeah, we're a foreign debtor nation. And look, there's a whole host of differences between the two nations. But at that point in time, the goal and the objectives of how, and Richard Warner has that amazing book, and that I only really got to know of him or got reintroduced to him when I saw that video that we once saw.
Oh,
together.
the documentary.
Yeah.
I'm literally like stopping people in the street. I finally shut up about the social dilemma, and now I'm like, you got to watch Princes of the Yen. So
no, it's absolutely, and it's amazing how they took something that was like a wartime finance objective of just keeping your economy always building stuff, even if you don't need to build stuff.
Right.
And it just built out these massive excesses in the system. And then on top of that, the leverage that was being afforded to anyone that had a heartbeat.
Right.
So, I mean, I don't think we're there.
That's different than what the Federal Reserve's trying to incent lending.
Yes. So there's not like this window dressing kind of, we're going to force you to have X amount of specific lending quotas per year. I doubt the Fed will ever get to that point. I just don't think that that's within their remit. And also, I mean, I know like a lot of folks, including ourselves, like to give the Fed grief, but they're operating with huge constraints around a global dollar system, which again is also part of the plumbing aspect, which you have to get familiar with. Right. And they themselves don't know where everything is. They don't know where all the dollars lie, where all the obligations are. I mean, in many ways,
in broad terms, can you set apart the dollar funding in the United States versus the dollar funding offshore?
Sure, very simplistically. I mean, so since they don't have access.
I mean, size.
Oh, size. Yeah, roughly 12-ish. I mean, it depends, right? You know, the Fed just pumped in a couple trillion, and as we've written before in the past, a lot of the dollars actually are outside the U.S. anyway.
Right.
Both the hard cash as well as some of the liquidity. I mean, let's say 12 to 14 on a given day trillion, and they're not reservable assets. They're against either treasuries, what they have to own, or
like China and Japan.
Yep. But they don't have access to the Federal Reserve's balance sheet. They're not directly going through that channel, which the U.S. banking system has, right?
Right.
So look, it's fascinating to think like we can maybe replicate a Japanese type bubble, but because we're the reserve currency and the Fed is still trying to be methodical, even though they've changed their new mandate on the inflation targeting. I just don't think they're going to let the wheels come off.
Well, they're certainly doing everything they can to prevent that. But in doing so, you get asked all the time, I get asked all the time, is this 1999 or is this 2007? My stock answer is yes. It's just yes. But the leverage lives in a different place today than it lived in 2005, 2006.
Sure. And maybe it's by design. Like you just distribute all the leverage into a lot of different pockets and you kind of deal with all these mini fires as they go. I mean, like...
Well, the corporate debt market's pretty grande.
It's big. It's big. It's big. And look, and that's why they did what they did basically this time last year.
Right.
They had to address the corporate bond market. It's, I was thinking about it on the way in, and maybe this is not going to be PC, but I'll say it anyway.
You're in the right place.
Yeah. The central banks are always fighting the last war, right? Or the last battle, whatever you want to call it. And it's almost in a way like how industrialists and overall just globalists are now obsessed with ESG, and that somehow we have to fix all the wrongs of the past, of all the pollution that was created. And you expect to fix that overnight? I mean, it does not happen. And the central banks are faced with the same challenges. Their predecessors give them like another bubble. They're like, all right, you deal with it. And they're like, oh, how do I deal with it? Okay, I'll just do more of the same. Like, how does that fix anything?
Yeah, I mean, it's funny because now we have Yellen and we have Yellen's former deputies, and they're now inside the Treasury and they're looking at revisiting Dodd-Frank. I'm like, wait a minute. We're in a different place than revisiting Dodd-Frank today. Sure. Simple as that. But anyways, but to answer the question though, I answer the question. I say yes. Is this closer to 1999, 2000, or closer to 2007 in your view?
I would say it's more like 2000 than 2007.
Okay.
Because although there is elements of the credit market that are super levered, and there's the zombie companies, and there's a lot of leverage actually just last year alone that was unleashed because rates were so low, and there was like this mad dash for credit.
Yep.
Like those investors, whoever bought into the credit market, and we're seeing it in the LQD, and you're seeing it, like they're gonna be nursing losses unless rates start rallying back hard.
Right.
So you've kind of locked in people last year into permanent losses on their fixed income that they bought during a pandemic to help keep things together. Okay, fine. You can say it's a throwaway.
There's a $2-3 trillion of corporate debt issuance in America in 1 year.
At a loss.
Yeah.
Now sitting at a loss.
Sitting on paper losses.
Paper losses, yeah, but fine. There are losses, right? And still, impacts overall total returns and portfolios when people look at it. My bond portfolio is not really doing anything any longer. So at this point, but it's not like the same sort of leverage like we had in 2007, which was like CDOs squared and CDO. It was like leverage upon leverage upon leverage.
Right.
So it won't cascade as much. It shouldn't just it won't start to amplify if something really goes bad.
And it's not concentrated on bank balance sheets.
Yes.
And off bank balance sheets.
So that's why it feels a little bit like a supercharged version of the TMTs that we saw coming out, like, the WorldComs,
right.
Coming out of 2000 into 2002, when we realized, oh, look, these guys cannot service their debt and they have too much of it.
Right.
I feel like,
that's why we say 1 out of every 5 large U.S. companies is a zombie.
Yeah.
They can't, if there's a blip, they can't service their debt.
Yeah. So that's what I mean. I feel it's more like a death by 1,000 cuts on the credit market.
Mm-hmm.
And the Fed wants to control it. I mean, they want to basically try to ease the pain and elongate it as long as possible, with the hopes that the economy will then increase to service those cash flows. That's the bet they're making.
So they're also trying to control 2 distinct phenomena right now. So maybe you can take us back. I'm sure you'll never forget the weekend. I'll never forget the weekend when Steve Mnuchin put out a formal press release that said, I've spoken to all the leaders of all the U.S. banks and everything's fine. And everybody went, what did he say? And why did he say it? And why did he say it poolside at Cabo? What was so important that he needed to pull away from his vacation? But Steve Mnuchin understood a lot about the financial system. So that was the beginning of what people call repo madness, but they don't begin to understand.
That's right. That's really, that's 100% right. I mean, think about it. That's now going on, 2.5 years, 2 years and a quarter.
September.
Yeah.
But this is prior to September of 19.
Yeah. So 2 years and a quarter, right? So it's over 2 years now since that happened, but it feels like almost yesterday in my mind, and I'm sure to you too.
Oh yeah.
And it's, again, that I agree with you. That is the marker of when we knew that something was up.
Yeah.
That was the starting point. But because there's so much liquidity in the system in general, it kind of washes away some of these things. And then, of course, we had Powell pivoting hard in January.
Right. But prior to that, the Fed was raising interest rates and the Fed was shrinking its balance sheet. And the market, was screaming, you're tightening too much. And I mean, this was...
Yeah, there was a double barrel tightening of rates and quantitative tightening, which I was very vocal about that as well. And they were like, oh, it's like watching paint dry. It's like, balance sheet on autopilot. But then 2 weeks later, the autopilot got thrown out the window.
Yeah, that was some scary paint that was drying. That was like blood paint. It was bad. Anyways.
Yeah, so I feel like because obviously the policymakers want to make sure that the core of the system is obviously steady and
held
liquid
intact.
And held intact. I mean, I think it was kind of an awkward message because a lot of people were looking at each other like, why was this being released now? But it was happening right around the time where there was big changes in reserve balances within the system, kind of like what we're seeing now too.
Right.
And the Fed was like the one last big kind of quantitative tightening part, and it all just kind of ended in that last week of 2018 around Christmas week into the New Year's. I feel like it was a panic move, personally speaking, but because of what was happening in markets and the jitters, I think it was more to signal a sense of calm. But now they realize we cannot. The banking system's plumbings and how cash flows operate. This is very micro, like intraday. Like when does something happen at 8:30 in the morning versus 10:30 in the morning has a huge consequence of like who's short cash at that window, during that window. So I feel like, it was trying to calm those fears. It was also during the break and the markets were going down a lot. I think it was a signaling effect, but the root cause, I think at a minimum, I don't want to dwell on it, they realized it was the liquidity shortfall that you can't take reserves down too much.
Right. Plus you had, as you explained to me at the time, you also had the world kind of crowding into physical currency, physical dollars. And at the same time, outside US borders, there were major economies that had negative interest rates. So their central banks would come to the Federal Reserve looking for positive, someplace to park there. And that was half of what was going on in terms of the tightening. The quantitative tightening was in addition to that. So and so there were just a lot of things culminating.
I'm sorry, you're right. And I forgot I should mention that too. Because when people look at the Fed's balance sheet, they don't look at the pieces of it. Right. Especially on the liability side. And it is wonky stuff. So you almost kind of throw it all into one big pool. But yes,
but that's a lot of physical $100 bills. Yeah, currency, people are like
currency in circulation, but also the foreign reverse repo, or the ability of central banks from other countries to deposit money at the Fed, because the Fed just basically was the last hike in December. Right. So move
and
cash.
then came the Powell pivot.
Yeah, exactly.
So we don't have to go through everything that happened in Volmageddon and leading up to not QE. But what culminated with not QE, and you pegged this at the time, and headed into 2020. So this is towards the end of 2019. And the Fed is doing can you explain what not QE was?
It was, in their eyes, when you're buying short-term treasuries that are similar in maturity profile to reserves, which they're not, they're a little bit longer than overnight.
Up to 12 months.
Up to 12 months, but it's overnight money and it's short-term in nature, like T-bills. They're buying T-bills. It was primarily targeted at T-bills at that time. That it's really neutral, and it's not necessarily adding, it's not the original definition of QE. The QE that's meant to do credit easing, force people out the risk spectrum.
Make it easier to get a mortgage and all.
Whatever. Okay. Yeah, and lower term premium to buy mortgages and to buy longer term credit. They were viewing that the not QE is not meant for that. And in reality, though, in a way, and this is just in hindsight thinking through what they did, perhaps they exacerbated what happened into March of 2020 by taking out the high quality short term assets that everyone wants. Right. Which goes back to my initial thing.
And at the time, some very quiet credit market players who'd been around for a very long time were saying there might be too much leverage building up on corporate balance sheets, and we might start being losing trust in some of the credit. And that was happening in the background. And when we were speaking back then, you kept saying to me, and it's taken me a long time to figure it out. You kept saying to me, the system wants real QE. They want the real thing. But the Fed couldn't launch true quantitative easing, credit easing, the way it was post-financial crisis, without a crisis.
That's right.
So, I know it's blasphemous to say, but the Fed needed a crisis headed into 2020.
Look, it was either going to be natural born, and unfortunately, obviously, it came via the pandemic. Right. Or it was going to be that the markets were going to, at some point, have a sudden stop.
And demand it.
And you would actually just see credit spreads go anyway, widening. So the conclusion would have been the same, just the catalyst is different. Right. But the Fed, the thing that we have both observed, which is amazing, they were there waiting and ready.
Oh, they had that thing. And I don't think that people quite appreciate. I was inside the Fed when we were lowering rates to the zero bound. And at the time, it was very dramatic, and oh my gosh, they're getting close to zero, and what's going to happen if you get interest rates to blah, blah, blah. And then, they had to get to zero before they could launch quantitative easing and start to grow the balance sheet. But that took months and months. And what happened on March 23rd, 2020 took 5 minutes.
Yes.
And it was everything that we had seen leading up to the first time the United States had zero interest rates, plus quantitative easing, plus
new things.
Yeah.
No. This has been battle tested. There was a war room somewhere out there where all these hypothetical scenarios were thrown out there. This is the playbook. Right. You go like this, and you see if it stops the bleeding, and you see at what point does it turn. And in my view, and I think you share a lot of it, they went a little bit too far. especially on the size of the Treasury impulse. But there was hundreds of billions of outflows that were happening at that time too, and so it was such a fluid period. And I think that they want to calibrate, which we can get to later on how can they ever taper. but I think it was just a heavy-handed response, and then throwing in all these new credit vehicles into it.
Yeah, to where the state of Illinois or the MTA here in New York or any, so many different. When I was inside the Fed, we debated for months corporate credit. We debated for months separately municipal credit, and it was all like right then.
But that's why it goes back to December 2018. They knew that the clock started ticking at that point.
Yep. Agreed. I agree. So, explain. So we know that today we've come full circle. So how on earth could we be back with all this QE and continued QE with a situation where at the shortest end of T-bills, 1 month, 3 month, they're trading negative. They're in such demand. And at the same time, people are, on the same day that a 1 month and a 3 month Treasury bill traded negative, the lower the yield, the higher the price. The long bond almost hit 2.50%, the higher the yield, the lower the price on the same trading day. What on earth is going on?
I haven't seen a 70 handle. The dollar prices actually looked like high yield bonds. Long-term treasuries were trading in $70 prices, which is, when you think of a bond, you're always like, oh, it's close to par. It's close to $100. I'm going to get $100.
It's a treasury. It's like backed by the U.S. government.
You're going to get $100 in 30 years, but probably don't want to wait that long either.
Right.
So, what's been happening, and this goes back to my first part of the conversation, why I'm so fascinated by plumbing and how we've done a better job of fighting the last battles, but we've introduced other constraints that has made it more difficult to allow the liquidity to flow to where it needs to go. And we haven't built or we haven't produced enough short-term collateral.
Right.
And this is why the Fed should not have bought all these T-bills. They should and I actually argue they should sell those T-bills and let the market have them. That's a different story we can talk about later. But there's a scarcity of where to park your cash on an overnight basis. And it's happening at a time where there's a flood of liquidity that's coming from the two pieces, which we both know, which is the Fed is still doing QE. 120 billion every month comes in and it goes into the system. But we also have now, as part of the Biden fiscal stimulus plan, and with what we were at least prior to the plan, but I'm sure we're seeing it in the numbers, therefore they are doing it. Janet Yellen, Treasury Secretary, laid out a plan of how they're going to use the cash that they built up last year.
So for people who don't, so this is all plumbing, this is all liquidity, this is all complicated. But let's just say that the United States government has a checking account.
Yes.
And they have that checking account at the Federal Reserve Bank.
Yes.
So as treasuries are issued, that cash has got to go somewhere.
That's right.
Because they've sold the debt, so they've got to put their cash somewhere.
Yeah, it's a temporary resting point before they distribute it for military expenditures,
income tax refunds,
Social Security payments.
Sure.
Basically everything that the government pays out money for comes one way back to the TGA in some fashion or another.
But there was a lot of it after, as the administration changed over.
Yeah, and that's the part that's so fascinating. We don't have to go into politics, but it is political in many ways, because all throughout last year, the initial reaction was borrow as much as you can because rates are low.
Right.
And let's just try to raise money to fund the CARES Act, because who knows, everyone was, scared of what COVID may actually turn out to be. So they overborrowed last year too. Right. And so the checking account balance was higher than it needed to be. Yeah. It's like, because
there weren't enough recipients out there to send money to.
That's right. It's like, as if you went and borrowed more on your home equity line, and then oh, I'm not going to build that extension. Now it's just sitting there. And you're like, okay, well, maybe I'll build it next year. But it's in many ways, it works like that. So they had over $1.5 trillion, almost like 1.8, I think, at the peak.
Yep.
Which was actually, in a way, also good timing on the part of Treasury Mnuchin at the time, because the money markets needed a place to park the cash.
Right.
And this is where this is the rabbit hole that I keep getting myself down. And sometimes I hope I'm being clear with those that are viewing and reading my stuff.
Well, so to differentiate, when negative interest rates initially came about in Europe, it wasn't this like DEFCON 1 disaster for the money market fund industry in Europe. I remember several of them closed because there's not as many of them.
Yes.
Over there.
Like I said before, the shadow banking system, which a good chunk of that 20 trillion is about 4.5 trillion money market funds.
Right. So that's a very unique aspect of the U.S. financial system.
Yes.
Okay.
And people view them as synonymous to having money at the bank.
Oh, money market fund to most Americans just means cash.
Money market funds is cash. It's either at their brokerage account or they actually hold cash in it. It's a higher yielding asset most of the time. So
it's if you've got a brokerage account and you have your money swept, it's swept into a money market fund.
And it's there. So it's money good, right? And within all the the legal constraints of protecting the dollar and the NAV. So in a way, and I was writing about this at the time, and I thought like they had to have issued those many T-bills, because if they had not, then those money funds that people were being defensive, selling their equities, drawing down cash, that took a while for that money to go back into the markets over the course of 2020. But initially, they just raised a lot of cash. And also, by the way, institutional funds saw a lion's share of that because all the corporate treasurers panicked. It was like, wait, we're going to shut down the economy? I got to make sure I hit my credit lines and borrow dollars because dollars are cheap.
So it was kind of like I see the forecast. There's hailstorms for as far as I can see. I'm going to max out my home equity line of credit just in case I totally lose my roof 3 times. But all the corporations did that when COVID hit together.
That's right. And it was just a massive flood that went to the money funds. And the money funds really did not have a place to put it. So it was actually really good timing on Treasury Secretary Mnuchin, a former, last year to issue over a couple $2.5 trillion. It was basically double the size of the T-bill market last year, and that allowed a home for all
the cash hoarding.
Yep. But in the process of doing that, they overborrowed at the same time, and then that money sat on the Fed's balance sheet. So now you have money markets, which are outside the banking system. They are, with these T-bills that they were now allowed to buy into. If they had not had that, they have this thing called the reverse repo program, which the bigger money market funds have been able.
Google it. Just Google it. Trust us.
Yeah, the RRP is going to be important going forward, especially what happened this week with the Fed and increasing the overall counterparty limits. It's going to be a bigger story going forward. So, long story short, the RRP is a place to park your cash. It's at zero, but it's not really an attractive investment. And T-bills were offering some yield, and the U.S. government wanted to pre-fund just in case we did a stimulus 2.0.
Right, which most people expected for Trump to sign into law before Christmas.
Yes.
And that didn't happen before Christmas 2020, and that didn't happen.
Right, because of all the political infighting
right.
and how it got dragged out all the way through beyond the election. And regardless of where you stand on that, it literally cost the American public access to capital when they needed, because that money was there. It was already borrowed. So now what's happening in this administration, they had that money because it was passed on to them from the other administration. And they're spending it. I mean, they've already spent like $400 billion, I think.
In a sense, the $1.9 trillion stimulus package was partially pre-funded because the money was already sitting in the government's checking account.
Yes.
But that means that they're not issuing T-bills to satisfy that. They're not selling fresh debt to finance the $1.9 trillion.
Yeah, and the investors that need that securities to put their money in, they're not getting it because now what's happening is a scramble to find anything that has yield, or sometimes they're going into negative.
Right. That's why we've got T-bills trading at negative yields, which is bizarre. At the same time that you've got all these movements in the NASDAQ. I mean, the FANG stocks, all of these. I remember that they were called the new utility stocks because they were money good, and they were the best place to park your money. Now they're being treated on any given day that interest rates are rising, people are like, sell the NASDAQ. It's just incredible.
It's become another side of a duration trade.
Right.
But back to the T-bills thing, which I know maybe it's a little bit too boring, but it's so critical to the function of what's taking place. And it goes back to what we discussed, how the Fed basically is burning the curve on both sides of the
both ends.
Both ends. Now they have a number of quagmires to resolve. Now they've skipped on the SLR, but then there was a follow-up kind of message that I saw quickly before our conversation, which shows that they're going to think about how they're going to tweak it over time, because they're going to have to tweak it.
They always leave the door open.
They're not going to say like this, we're done, this is going to be it. We're not going to. So they have that optionality now, that because they know they're going to be pumping in trillions upon trillions of reserves, encumbering the banking system. So
at some point, the checking account balance will be run down.
Yeah. So we're in the process of the checking account getting run down. The reserves are getting pumped up in the banking system.
And we're about to go into tax season. So the Treasury is going to be mailing out all kinds of tax refunds.
Yeah. So
at the same time as the stimulus payments and the new unemployment benefits. So there's all this money coming out of the government's checking account.
Yes. And there's some like chatter on Twitter, and I'm sure you came across it, how banks are holding back on cash or distributing the stimulus checks because there's so much cash in the system right now that's coming out of the government side, that the banks don't even know what to do with it. And so they're just, ironically, a lot of it supposedly was embargoed for the 17th, which was yesterday for people that are, or 2 days ago, for those that are listening. There's Fed Day. People maybe were watching or were hoping the SLR be extended. Long story short, we're dealing with, for the next 3 months, close to $1.5 more trillion coming our way.
Right.
That's bigger than what was released during COVID initial response in total. Once you do an annual change, that money has to go somewhere
before the need presents itself for the government to start borrowing again.
That's right.
In the T-bill market.
Yes. So negative rates. The Fed has that dilemma.
Right.
They didn't really do much this time other than expand the RRP program's counterpart limits.
They went from 30 billion to 80 billion for any given money market fund to park their money at the Fed to get yield, because they can't go into the T-bill market because yields are negative.
That's right. Because at this point, negative rates versus
zero. I'm trying to translate as we go, I promise.
No, I'm sorry if I'm going too technical.
No. But this is really important stuff.
Yeah, because who wants to have a negative T-bill rate? Unless you're forced to, like institutions have to. But if you can then park your cash at the Fed and get zero, at least zero, you're not losing anything.
Right, exactly. And they're not allowed. Money market funds are not allowed. And some of them are still losing money because it's not free to run a fund. So there are administrative costs. So let's skip ahead to the great debate. So, my Beltway contacts suggest that because the administration and the Democratic-led Congress can paint infrastructure spending as being COVID relief, that they might be able to pass another $3 or $4 trillion in stimulus in 2021 under the auspices of COVID relief, and therefore use reconciliation. Only 50 Senate votes needed to pass the legislation instead of getting that 60. So what if my Beltway contacts are correct? And what if inside this year, so the Treasury balance, the Uncle Sam's checking account balance is depleted. We get past this short-term liquidity crisis. All of a sudden, we're going in the other direction.
Yeah, and then it flips.
And then Uncle Sam starts to borrow a ton of money. Let's say you get a $3 trillion additional stimulus package. Then that gets us to the subject of inflation or deflation and the great debate going on Wall Street right now.
And who's going to buy all this debt?
That's right.
So I'm assuming, I'm not completely convinced that they're going to get it, but let's say they do.
I'm saying hypothetically.
Hypothetically, if they were to do that, it would probably have to happen in fiscal year 21-22. For those that are watching, the U.S. government operates on a 9/30 end of year calendar. Right. So after September 30th, it's a brand new year for the U.S. government. Mm-hmm. So they could, in theory, in October, November, December, launch some sort of stimulus package that's part of the new, budget process.
What lovely timing, because supplementary emergency unemployment benefits run out on September the 30th. So does rental eviction moratoriums and forbearance for mortgages, and all of these things end on September the 30th, on the last day of the fiscal year.
That's right. So if that were to happen, the way I think they would structure it, it still has to be a 5 or 10 year type window. Let's call it 300 to 400 billion a year.
Mm-hmm.
It's doable. It's doable, but it's still adding debt upon debt. And we last year was close to 5 trillion in terms of overall deficits. We're running numbers that are now 3.5, and then if you add this, you can get to 4 to you can get to really big numbers again.
Right.
And that's just unusual because coming out of the financial crisis, we ran 1.5, and that felt like ginormous.
The world is ending. Yeah.
So this is a lot of treasuries that someone has to absorb.
And China's already said, we have issues with the rate at which the U.S. government is running up their debt, ...
And they probably don't have enough dollars themselves to go buy it all because they have their own dollar funding needs, which is a whole other issue.
Right.
But it really is going to shift the onus to how much more does the Fed have to do?
Mm-hmm.
Can they really exit?
Mm-hmm.
And then, what's the clearing rates? And then if clearing rates get too high, what we're noticing now, because we're seeing the markets very volatile, that you go from 125 in the 10-year to 150, 175, and things start to...
the wheels start to fall off.
Yeah, so things start getting very volatile. If we get close to 225 on the 10-year without the Fed hiking, let's say they're true to their word, and I think they are. And I'm actually...
Oh, I think they're serious about this.
Yeah, they're not hiking. This idea of people like you see it, and it drives me bonkers. Maybe it's just because we're creatures of old habits or whatever it is, but most of the economists that I was reading, there's an exception that actually were like, no, they're really serious about the average inflation targeting. They're not going to move up the dots. But there's a handful that are like, yes, the Fed's going to acknowledge that there's growth coming, and they're going to mark to market to what's priced into the Fed fund strip and the euro dollar curve.
Yeah, then who's going to buy this theoretical next $3 trillion of debt?
I was like, no way.
Nobody.
It makes, they got to keep the curve as steep as possible, give as much carry to the banks, hope the banks buy it, work on some sort of compromise on this SLR over the next 6 months to a year. But
if in the background, the NASDAQ keeps falling out of bed because rates keep
high.
Inching up, as our friend, our common friend always says, the top 20%, the top third of income earners in America. So the people who are in that top third of the income rung are responsible for 54% of spending. Well, if the stock market goes down, they're going to be a lot more prudent in their spending. And that's a whole different way to make the wheels fall off of the economy.
Yeah, no, so we were kind of thinking in a linear fashion, but although the yield curve is not very linear, you throw in that third dimension, which is the wealth effect around. Right. So we have, Fed has a problem with rates on the short end right now for the next couple months. They have a problem with how high rates can really go. They're pretending that it's because the economy is getting better.
Right.
And they're acting indifferent towards that. And then, on the other side of the plane of this 3D world that we live in is real life decisions around how wealthy do you feel? And then how does that translate into the trickle down economics that they've been, forcing on, the U.S. households for the last 10, 15 years?
One of my favorite economic indicators is post-COVID in the business and professional services subsector, which is a large part of the labor market. More than 50% of the jobs created have been temporary. So if you're Joe Q CEO, you're waiting to see what's happening. There's a 61% correlation, co-movement between the stock market and CEO confidence. If your stock's going down, you're not hiring people.
That's right.
It doesn't matter what the Federal Reserve is trying to say. It doesn't matter how robust you're being told the economy is going to be because of all this stimulus spending. If your stock price is going down, you're not hiring.
That's right. And it really impacts the psyche of all those leaders when they're looking forward. Like, do I want to make those capital commitments? And actually, and also the human capital commitment, which is more important in my opinion. Like, you're not going to do that. And then this is why we've, coined the idea and thought about, starting points matter. Mm-hmm. There's along the way, there's short circuits that are going to happen.
Yep.
And it's not going to be a simple like we're going to look back and say, yeah, we turned on the economy, everything, the vaccine's good, everyone's going to go back to normal.
It was an inflation scare, even though we issued $5 trillion of debt, blah, blah, blah. There's too much from the starting point of going back to 1881, the stock market being in the 99th percentile of valuations.
That's right.
From that starting point. I mean,
so this is why I'm trying to say, they've always in the past tried to soft land the economy. Now they're going to try to soft land the financial markets. And it's a big task because they have curves. They have the credit market, which is linked back to equities. And then they have these high flying growth stocks, as well as all the speculation, which in their eyes, they probably don't care if Bitcoin goes from 60 down to 10,000 or 5,000. They don't care. It's small enough that it won't be systematic issue for the nation, for the nation or for the financial system. But you're going to see people start to lose money. They're going to change their behavior.
Right, and that's the point. And that's where we get to the Fed being in this box, because they have to convince investors, they have to convince the economics community that they're going to let inflation run hot. But if interest rates rise too much and people stop hiring, the wheels fall off. And I mean, that brings us to kind of the last big subject I want to broach. So again, we're just speaking in pure hypotheticals here, but we've gone to the end of this road together. We know how it ends. So let's just say that because they're paying people right now who are collecting unemployment so much money to not work, they decide that regardless of what happens, I'm not going to take this temporary job or whatever, they're going to stay out of the labor market and continue to collect these emergency unemployment benefits.
If they're available.
If they're available. And we know that they're available through September. UC Berkeley educated labor economist Janet Yellen. She wants to get money to the people. She's serious about getting money to the people. She's about the closest Treasury secretary we've ever had who understands not necessarily the plumbing of the financial system, but she understands that there is a transmission mechanism to get money directly into the hands of people. She knows how helicopter money would work.
Yeah.
So let's just say this permanent unemployment problem persists. I mean, we've got permanent unemployment in this country that's at the same level as what the great financial crisis was, still today. What can she do?
So this is where I try to be a little bit more neutral on what this means, because I do think there's a lot of pain and suffering out there, and it's not being addressed by having stocks at the highs. Like, what does that really do?
No. I'm not trying to imply that at all.
No, I know you're not.
I'm not.
I know you're not.
We've both been for more targeted relief spending instead of giving some 24-year-old $1,400 to put into his Robinhood account. Hello.
Yeah, I mean, the money was not earmarked for those that really needed it.
Right.
They could have done it better. They could have looked at the unemployment rolls for every state. They know who's unemployed and just pumped up their money or extended it even further. But yet blank checks for everyone in the U.S. I mean, look, people like to get free money. Don't get me wrong.
Well,
but it comes at a cost.
Ask any airline CEO right now. They're like, we're booked out to the summer. Everybody's got money. Great.
Yeah. Then there's a cliff effect. What do you do after that? You expect the government to keep giving you these kind of temporary
freebies.
These temporary infusions. I think it was those things were poorly handled, and they could have been done much better. We are the United States of America. We have the best Silicon Valley technology. You telling me that you cannot figure out who's unemployed and who's lost jobs and give them more money instead of giving it to everybody else? I mean, that makes no sense. I think everyone...
You could even do something radical, like try and give them a new job skill. I mean,
yes, that's where I'm getting to. So this infrastructure plan, if it's done the right way, and if it's done in a way where it's private-public partnership and
old school FDR.
Yes, bingo. If it's old school FDR, and you can, again, I don't want to go back to the 1930s for the bad parts of the 1930s.
Right.
But in terms of public works, in terms of, there's a lot of things that have to get fixed in this country. So put people to work there. Now the question is, can you incentivize them enough to pick up a shovel and a hammer and do something that they don't want to do instead of like staying home? Like, you have to get that incentive level high enough to say, we're not going to just give you free money. You have to actually kind of work for it, but you're going to make the country better. And then you're going to have a skill that you can employ somewhere else.
This is my favorite subject, George. I mean, I can talk about infrastructure 24/7. And if it's public-private partnership, then the private aspect is going to make sure that they don't lose money, which means that taxpayer money doesn't get lost.
It's a win-win.
Totally.
But, I mean, the fiscal multipliers have been proven over and over again to be inefficient ways of trying to generate growth.
Right.
And it's only gotten us to where we are now, which is a highly indebted both at the government level as well as the corporate level.
Mm-hmm.
There's just too much debt, and it hasn't really, created all the turns of growth that we should have had.
Right.
So the internal optimist, in the next 3 to 6 months, I can see us just rip roaring because there's so much liquidity out there.
Oh gosh, yes.
It's hard to be. You have to, and you're like, you do amazing work with your daily updates on what's going on with economic activity, as well as the weeklies. But it's hard to dismiss that. Wow, all this money is coming in. It's impossible. It's all priced in. It's going to help out the industries that need it, and good for that, right?
Yep.
But then what? What do we do after that? So that's the part.
So spring break, summer vacation, yes. They just canceled Christmas.
Yeah, they won't, and then we know they won't, right? So
no.
So we'll have some sort of bridge. Maybe we don't get the full infrastructure plan as we're discussing, but we'll get some sort of bridge into the fourth quarter. And the real target of all this is the midterm elections.
God, we're talking politics already.
I know. I'm sorry.
Oh my God.
I know, but long story short.
But that's what. Let's just be apolitical and say that's the GOP's hoping all of this does not work. That's what they're banking on, so that they can take back the House and the Senate. And it's not a political statement to say I hope the opposing team loses.
No, because it works on both sides.
Right.
However, it's a very delicate message to deliver still in the midst of a pandemic. Mm-hmm. So the key really being is you need to get the economy opening and operating on its own 2 feet to prove that it can actually operate within a new framework of social distancing and increased vaccines and hope for herd immunity, that it can prove that, wait, we're self-sufficient. Look, we're Americans. We can actually do this.
Right.
We can get the economy back online.
The private economy can create jobs.
Amazing.
And make money, and people can make more money than they will make money relying on the government.
And you don't need the government to do that for everything. So if that happens.
But hypothetically, we're running out of time. Hypothetically, and this is a big subject, can Janet Yellen deliver money directly to the people? Is universal basic income in its purest form feasible in the United States with the current currency construct that we have?
Currency and payment system, right?
Payment system.
And because you saw all of the inefficiencies and all the horror stories that people never got their actual stimulus checks.
Right.
They got lost in the mail. Again, this goes back we're 2021. We have the best technology, and we invent everything in the U.S.
And we can't get $1,400 from the government to a person.
Yeah. What's wrong there? The challenge is, and knowing the plumbing and how the Fed's payment mechanisms, which are evolving, of course, over time,
right?
But they're not in that at that place yet. And
China's playing with it.
So this is the end game. This is the end game.
China's starting to, in any given city in China on any given week, they're going to have a pilot program running where they kind of give away monopoly money to people. And they say, this is nothing real. We're just doing a little experiment here. But by the way, the monopoly money that's on your phone that we want you to use this app to access buys real things.
And it expires if you don't use it.
And it expires if you don't use it. Exactly.
So this idea of electronic cash, we're so many years away from it. Maybe I'm wrong because.
But what happens if China does it in 2 years?
It's different. We'll see. But the U.S. still is the reserve currency. We'll see what it means more if the U.S. does it, and that's why we're taking our time to make sure it's right. That's why I feel like we're going to probably have another crisis before then.
Right. Before
they throw up the idea that we have to abolish cash, or not abolish cash, but really take away the dependency on paper cash and electronic payments through the banking system, which is another hurdle, and go directly to the people through some sort of wallets or direct deposits. That, I think, is still down. It's in the background. But look, I was surprised, I know you were too, how fast they did it in March, all these things, right? So they're working on stuff. Don't get me wrong.
As a matter of national security, if China's working on it this hard and other countries like Russia and Venezuela have already gone there, somebody somebody in the State Department, somebody in the Pentagon, somebody at the New York Fed, they're working on it.
Boston Fed actually has a big joint venture with, I think, MIT or somebody.
Okay.
And they're working on.
So they got the smartest people in the world working on it.
Yeah.
Okay.
And most MIT folks run the Fed or central banks around the world, right? So I think it's coming, but I don't think it's going to be in place at a time where Janet Yellen, or just through the Fed channel Treasury money into banking system will happen yet. I still think they're going to rely
We need
on
another
this.
crisis,
Yeah, we need another crisis.
which we don't want.
Well, which we don't want, or we need to get into this slow burn. I mean, I'm of the slow burn philosophy for the medium term,
Mhm.
and then relatively optimistic the long term, because I think that freedom-loving people are still going to want to have their privacy. They're going to still want to have access to their capital and cash, and they're not going to want everyone watching every little step that what they're doing.
We're not a monitoring type country. This is not the KGB.
And I don't think the Fed wants that either, deep down inside.
No, rare that these words come out of my mouth, but to Jay Powell's credit, he's always said, if there's a Fed coin, if there's a digital currency, it will be just as anonymous as the dollar bill in your wallet. We will not be spying on you.
Yes, I generally believe with that. I mean, they can probably track patterns and do other sort of analysis, but I think it will be meant to address some of these short-term issues. Because at the end of the day, as we've seen all along, they overflooded when there's a problem, and then it becomes inefficient monetary policy.
Mm-hmm.
If there was much more targeted, they're like, look, we have a hurricane that hit, South Florida, and it needs a lot of money, and the banks are offline or whatever. You can get it into your phone,
right?
And you can take that phone with a QR code and
Sure.
pay for food. Like, hey, this is what the world is moving towards. So the central bank that's smart to jump on that is important. And what the Chinese are doing with their payment system, I mean, I think it's very local. It's still small. It's embryonic. I don't think the world's going to embrace it either. I think the US dollar and whatever e-dollar Fed coin that we invent will still be the basis for a lot of transactions.
So great country. Love American innovation. Love American cars.
Yes.
All right. So my father was too spoiled. Son of immigrants, got into University of Connecticut, 1964 Stingray, wrapped himself around a light pole. 8 surgeries later, they managed to save him, which is why I'm here.
This is good.
I was partial to the 1966. However, I recently saw the brand new Corvette. And wow. I mean, wow. You can put that next to McLaren, and it's a beautiful, I was in Florida. That's where they drive all these things.
Of course, yeah.
So, but the brand new Corvette. So, all right.
I've seen
What's the best year of Corvette? By the way, George, we're both gearheads. Bigger gearhead than I am.
So, I mean, just so...
Because this is important. What's the best Corvette that was ever made in America?
I can go down lingo. I mean, I've seen people, what's called debadging. They take off the Corvette symbols in Chevy and they pretend it's a McLaren because it really looks that good. I mean, it's a very...
Okay, that's not nice. You got to be...
People are always trying to like...
proud of that American car.
Fine, whatever, but I'm joking. No, it's an amazing car.
24 Hours of Daytona years ago beat the Ferrari. Both U.S. Corvettes, even though they could put anything under the hood. But anyways, the best vintage.
It's a tough one. I mean, I do like the 1960s.
Those Stingrays were beautiful.
The Stingrays were really, just a classic.
They don't take regular unleaded though.
It's hard to drive nowadays. You have to really find a special place to do that.
Mm-hmm.
I personally have 2 Corvettes. So I have a 1990 Corvette ZR1, which I rebuilt myself.
I know. I'm jealous.
And so that's my personal favorite because I'm a kid from the 80s, 90s. And so I always wanted to have a 1990s Corvette ZR1, which was half European, half kind of like me. I'm like Portuguese and American. So it was like a perfect combination of European technology on, which is still an amazing engine. It operates 32 valve, four cam.
They're allies. That's okay.
Yeah. They have Lotus in UK. So I would say that probably started the cutting edge side of Corvette engineering, and they started to up the ante, and then all the subsequent Corvettes have been just amazing. And then I have a modern day which it's called C7. The new one is called the C8. They go by vintages. So like C4 is the one that I have, which is a Corvette ZR1.
Next down the middle with George and Danielle is going to be on a racetrack. We're just going to get a fast camera to go with us.
Which, by the way, I'm also a part of a racing club with...
of course you are.
Which you kind of have to be. There's a great place down in New Jersey called the New Jersey Motorsports Speedway. I'm a member down there. Because you can't go fast in the streets with these cars. But I've taken it up to like 170. My new Corvette, which I supercharged, and I have over 800 horsepower. It's insane. It literally, I can spin it in third gear. I mean, it just like...
Now, my oldest, who's a gearhead, so he's a 4th generation gearhead, I'm going to let him watch like the last 5 minutes of this interview, and he said, Mom, how do you know him? And we have to go visit him in New Jersey. I can hear it now.
No, it's definitely a passion of mine. And it really, to be honest, in a weird kind of nerdy way is what got me really interested in fixed income too. I would study every single fact sheet of how, how cars are put together.
Right.
Like, how just overall the camshaft lobes, what's going on with what kind of gear ratios. I mean, I like new stats, like people would know baseball RBIs for their favorite player.
That's the true gearhead stuff going on here. And you
when,
can't ever run out of liquidity with a car either.
No.
Then you're up a creek.
You gotta find it. So if you can do that sort of stuff, then you apply it to understanding all kind of bond descriptions and all the sort of things that make a bond work. You can basically
Future
memorize
rate
anything.
strategists, I hope you're paying attention. Finance majors right now.
Just
go figure out
memorize.
how to take a car apart and put it back together.
That's right.
George, thank you. Thank you so much. This was very timely. All this stuff is happening as we speak. We so appreciate your time, and I hope we can do this again soon.
Likewise, my pleasure. Thanks for having me.
Well, now you might have a better idea of why when I was in high school, they called me a nerd. I really do love to get into the weeds, to understand the plumbing of the financial system. There's nobody understands it better than George, and I hope you enjoyed that. If you didn't understand a few of the terms, just Google them, and you'll thank me for it later. One of George and one of our shared inspirations, Richard Werner, he was embedded in Tokyo when the massive crash happened in 1989. He did extraordinary work, and so I've also interviewed him. If you want to look back at a little bit more in-depth, see at what happened then and whether or not there are implications for what's happening in the United States now. So be sure and catch that interview if you missed it. And of course, if you have not subscribed, please do subscribe. Please subscribe. And I look forward to the next time for the next edition of Down the Middle. Thank you.